Thanks very much. Thanks everyone for being with us here today. So I'm Hilda from Schroders, Asian Fixed Income Product Manager. So today, as you can see up here on the screen, the title of my presentation is Asian Credit, Giving Credit Where Credit is Due. Now, we thought this topic would perhaps be interesting or relevant to many of you here because Asian credit is an asset class that's often overlooked or underallocated to, but also an asset class which we believe deserves a lot more attention than it currently already gets. So today, in my presentation, I aim to answer 3 key questions for you. Why Asian credit? Why Asian credit now? And why Asian credit via Schroders? But before we begin, what is Asian credit? So when we talk about Asian credit, we are really referring to US dollar-denominated bonds issued by issuers from within the Asia region itself. But of course, for many of you here who might be Sing-based or Sing dollar bond-based investors, typically for Asian credit mutual funds, we also have Sing-hedged share classes, so you are not exposed to the currency volatility involved from the USD to the SGD. So to begin with, why Asian credit? Now, we thought it would be helpful to first start with a market overview and also understand some of the key merits that this asset class brings. So here you can see that the Asian credit market has grown exponentially over the past couple of decades to reach more than $1 trillion in terms of market value right now. So this actually puts it pretty close in size compared to the US high yield market, definitely an asset class that is growing and increasingly too large to ignore. Now, an important feature of this asset class that's worth highlighting is that the Asian credit market is fundamentally a very high quality one. So if you're to see here, based on the breakdown between the green and the blue color, so the green color actually represents the investment grade segment of the entire Asian credit market. Now, as we know, the investment grade issuers refer to companies which are typically a lot more stable because they also have stronger credit profiles. And right now, the investment grade segment takes up more than 85% of the entire market. And this actually brings the overall credit rating of the whole market to a very high rating of about A- as we speak. And this actually puts it much higher in terms of credit quality compared to many other emerging market fixed income asset classes, for example, in Latin America or in CEMEA, where on average they are rated BB+, and that puts them in the high yield category. Now, not only is the market a very large one, it is also a highly diverse and dynamic one, really allowing investors to assess very varied opportunities all within one market itself. So here on the left-hand side, you can see the breakdown of the market from a geographical point of view. And clearly, China takes up a very huge percentage of the market at about 40% right now. And this is also why we often advocate for a more active management approach, essentially via mutual funds, as opposed to passive via ETFs within the Asian credit market, really to avoid concentration risks within a particular market. But of course, on top of China, we do see quite a nice representation of many different economies. And that is to say that when investors invest within the Asian credit market itself, they do get access to issuers that are exposed to very different factors, depending on the economic, political, and regulatory landscape in which they're based in. Now, on the right-hand side, similarly, from a sectorial point of view, you can see a very wide range of sectors being represented in the Asian credit market. And this actually makes the Asian credit market a lot more diverse and dynamic as compared to the US fixed income market, which many of you might be invested in, because the US fixed income market is made up majority of US sovereigns, or as we know it, US treasuries. So here, to put things into context, I'll give you some examples. So within financials, you will have US dollar-denominated bonds from the likes of DBS, OCBC, UOB, Bank of China. So names that you perhaps are very familiar with. And what makes Asian credit quite unique as compared to Asian equities would be that we also have sovereign representation. And essentially, these are US dollar-denominated bonds issued by Asian governments, with majority coming from Indonesia and also Philippines. TMTs, we have US dollar-denominated bonds from the likes of Alibaba and also Tencent. So not just names that you're familiar with, but perhaps even names in which you are even users or customers of. Now here I wanted to introduce a phenomenon within the Asian credit market that makes it pretty unique compared to other emerging market fixed income. And that is the Asian bid. So when we talk about the Asian bid, essentially it refers to the trend of in-region Asian investors forming the majority of investors within the Asian credit market itself. So here you see the breakdown in terms of issuer base on a historical basis within the Asian credit market. Asian issuers being the ones in blue. And quite clearly, over the years, Asian issuers have taken up an increasing proportion of the entire investor base at about 76% as of Q1 2023. Now, this is much higher compared to many other emerging market fixed income. For example, within Latin American credit, LATAM credit is majority taken up by US-based investors at about 58%, and only a mere 5% is taken up by in-region Latin American investors themselves. And the fact that we have an Asian bid is definitely very supportive and helps to anchor the entire credit market over the longer term. Because if you think about it, during times of market stresses or significant market volatility, investors that are based within the region are less likely to withdraw their money very quickly or at large amounts, because being based here, they tend to be more familiar and also comfortable with the names in which they're invested in. And over the longer term, this has actually gone a long way towards lowering the volatility of the entire asset class, something which you'll see in a few slides later. Now, from a valuation standpoint, Asian credit is attractive. So here we actually show the corporate spreads across different regions on a historical basis. And quite evidently, Asian credit, which is in black, has actually offered a spread premium or a spread pickup compared to other developed market fixed income, including the US and Europe. So to be more specific, within the investment grade space, Asian investment grade credit offers a 60 basis point spread pickup as compared to US investment grade at the same average rating of about A-. On the high yield side, Asian high yield offers about 440 basis points of spread pickup as compared to US high yield, but at a higher average credit rating of BB- as compared to US high yield, which is on average rated single B+. So from a spread versus credit risk kind of perspective, I would say Asia credit offers a lot more value to investors. Now let's take a look at risk. So on the right-hand side, you can see the volatility of the asset classes across different regions on a historical basis. And evidently, Asian credit or Asian investment grade credit has historically offered lower or the lowest volatility as compared to many other fixed income regions. And you would recall that earlier on I mentioned that the investment grade segment actually takes up a huge majority of the entire Asian credit market. So this is to say that the Asian investment grade segment really helps to anchor and stabilize the entire asset class, giving a lower volatility kind of experience for investors within the Asian credit space. So with lower historical volatility and also higher returns, it's perhaps not surprising that Asian investment grade credit has offered a much stronger Sharpe ratio, or essentially risk-adjusted returns, as compared to other regions on a historical basis. Now, by now, I've spoken about many different concepts, and you might be wondering, so how should investors be looking to use Asian credit within their portfolios? I think an important point to highlight is that we're not saying that you should therefore allocate your entire portfolio all into Asian credit itself. Rather, what we're saying is that by adding Asian investment grade credit or Asian credit into your portfolios, you can potentially diversify or benefit from the diversification potential of the asset class itself. So on the left-hand side, this table actually shows the correlation of Asian investment grade credit compared to other high-quality asset classes across different regions. And clearly, Asian investment grade credit has very low correlations on a historical basis compared to many of these regions. And this also means that by adding Asian IG into your portfolios, you can potentially optimize or enhance your portfolios from a risk-adjusted return point of view. On the right-hand side, this is exactly what we see from an efficient frontier standpoint. So here we actually build out an efficient frontier using several asset classes which are perhaps quite common in your portfolios. The green dot on the left-hand side, on the right-hand side, being a very typical 60-40 global equity versus fixed income kind of portfolio. So as you can see, if we were to add Asian investment grade into your portfolios, it can potentially push the portfolio out further up into a more effective or attractive region. And this essentially means by adding Asian investment grade credit to your portfolios, you can potentially maximize or optimize your portfolios and make it a lot more efficient than it might already be. So I've spoken quite a bit about the entire market itself and also some of the key merits that it brings. And at this point, I wanted to share a few reasons as to why you should be looking at Asian credit based on the current market environment that we are in. It's perhaps useful to first start with an overall macro backdrop in which we are operating in. So as you would know, this year we've heard many concerns about a potential global recession or global growth slowdown. And I think against this backdrop, Asia as a region actually stands out very much as a bright spot because the region is positioned very strongly relative to the global economic cycle. On the right-hand side, APAC is expected to contribute about 70% of global growth this year, definitely a key driver of growth for the world. If we were to break this down in terms of growth or expected growth across different regions, on the left-hand side, you would see the IMF forecast of growth across different regions this year compared to 2022. On the far left, you can see that the world is expected to grow slower this year at about 2.8% as compared to last year. And this is also a similar trend which we see for different developed markets or emerging market economies, including US, Europe, Latin America, and also Middle East. But on the contrary, Asia, which is boxed up in orange on the right-hand side, is expected to deliver stronger growth this year at about 5.3% as compared to 2022. And this is not just driven by the whole China reopening story and therefore China's growth, it's also driven by very firm economic outlooks from major economies in Asia, including India and also Indonesia. So Asia as a region definitely represents an investment universe with ample opportunities for credit selection in 2023. Now let's take a look at fundamentals. So fundamentals within Asian credit or Asian corporate issuers has been very resilient, particularly within the investment grade segment. So whether we look at leverage ratios or liquidity ratios, overall credit fundamentals have been strong or credit profiles have been strong for investment grade corporate issuers since last year and also this year, and in fact improving at several segments within the IG space. And already, we have started to see these stronger fundamentals being fed into the rating actions that we've seen. As you can see on the top, for the investment grade issuers, we have seen an upward momentum, which essentially means that we've seen more upgrades in terms of rating actions as compared to downgrades within the investment grade space. And overall, this actually positions these issuers very well against an overall backdrop of a potential global growth slowdown and also tighter credit conditions as well. So from a valuation standpoint, we all know that the global credit markets have actually experienced massive repricing over the past couple of years. But because of that, it has actually led to very attractive valuations within the Asian credit space. So here we actually show the average prices in Asian investment grade and also high yield on a historical basis. And clearly, where prices are trading at right now, it represents a huge discount compared to longer-term averages. And the last time we've seen such attractive valuations was back in 2008 and 2009 during the global financial crisis. And it's also pretty evident how strong the rally or recovery was thereafter. So right now in the investment grade space is trading at about 12% discount compared to long-term averages and about 30% discount within the high yield space compared to long-term averages. Now, as we know, bonds tend to pull to par, so assuming there are no defaults within your portfolio and you got your credit selection right, this actually represents an extremely attractive entry points for investors within the Asian credit market. Of course, it's not to say that you should therefore allocate your money all into Asian high yield just because it's trading at a larger discount. We have to remember that the high yield segment inherently incorporates a lot more credit risk and is therefore only suitable for investors who have a stronger risk appetite and can stomach the volatility that investing in the high yield segment brings. Now, looking at it from a slightly different perspective, from a yield point of view, the yield landscape has also transformed dramatically over the past 2 years. But this allows fixed income to once again offer the income that investors are looking for when investing in this asset class. So here we chart out the historical yields across investment grade and also high yield. And clearly, where yields are trading at right now, it's much more attractive compared to just 2 years back. So to be specific, within the Asian investment grade space, it currently offers about 6% of yield on average. And this is much higher than the longer term averages of about 4%. In fact, the highest that it's been in 14 years. So this is to say that Asian or investors now can actually build a very high quality portfolio all within Asian investment grade or the Asian investment grade segment, and thereby allowing the Asian investment grade segment to once again offer very attractive income generating opportunities which are relatively more stable. And at this point, you might be wondering, how does Asian yields stand compared to other regions in the fixed income space? Here we have it charted out from a yield versus duration point of view. So as we know, duration measures the interest rate sensitivity of the asset class, and effectively it's also a measure of risk. So it's therefore a lot more attractive to be positioned on the top left corner of each chart. And here we actually have two sets of data. So the ones in dark blue, or the points in dark blue, represent the points which these asset classes were in December 2021. And the green one being the points they are at right now. And quite clearly, if we were to compare the blue versus the green, I think the trend is pretty obvious, whereby fixed income asset classes can now or offer a lot more attractive yields to investors. But if we were to compare between the green dots or across different regions, evidently Asian credit is positioned a lot more attractively from a risk-adjusted yield standpoint. Or to put it simply, giving you a lot more bang for your buck right now within Asian credit. So I've spoken at length about the Asian credit market, and at this point, I wanted to spend some time to introduce our 𝗪𝘆's Asian credit platform and also capabilities. Here you see some of the key highlights of our Asian fixed income platform. Now, as you know, 𝗪𝘆's has operations globally, so we do have investment professionals based across different regions across the globe, all dedicated towards their respective asset classes and also expertise. And in 𝗪𝘆's, we have aligned our credit platform globally. So that is to say that our Asian credit team that's based within Asia itself has seamless and very regular access to our entire global platform's resources and also expertise as well. Of course, this is very important because, as you know, Asia doesn't operate as a silo and is definitely impacted by developments across the globe. Importantly, within Asia, 𝗪𝘆's boasts one of the best resourced Asian fixed income platforms with more than 30 investment professionals dedicated towards Asian fixed income, and they are based across different markets in Asia itself. For example, Singapore, Hong Kong, Shanghai, Indonesia, etc. And I think something that's really powerful or gives us an edge compared to many other houses is that within Asian fixed income, we actually have expertise across the full range of Asian fixed income capabilities, including Asian rates, Asian currencies, and of course, Asian credit as well. So although the Asian credit team are the ones who manage our Asian credit portfolios, the fact that we have an Asian rates team and also an Asian credit team within Singapore is something that's really powerful because the interaction between both teams really helps our Asian credit team to develop a more multifaceted view of the entire Asian credit universe and also the issuers within. We've been invested in this space for a long time, in fact, since 1998. And I think considering the fact that the Asian credit market is a relatively young one, this also means that right at the very beginning, when the market has first started to grow or develop, we have already been in this space, invested in this space, and also analyzing the issuers within. And over the longer term, we have delivered also a very strong and successful track record in Asian fixed income. Over the years, as our team and also platform has grown, so has the AUM that we manage. So as we speak, we manage more than 11 billion worth of AUM, all dedicated towards Asian fixed income strategies. Definitely a very trusted investment partner within the Asian credit space. So zooming into our Asian fixed income platform, here's how we are set up within Asia itself. So on the left-hand side, as I mentioned earlier, in blue, we have our Asian macro team. So that covers our Asian rates and currencies capabilities. On the right-hand side in green, we have our Asian credit team. And essentially, they are the people who manage our Asian credit portfolios. And quite evidently, you can see that we have a very well-resourced and robust platform. So on average, we have about 14 years of investment experience within Asian fixed income across all the professionals that we have. Focused on Asian credit, in green, we have our Asian credit fund management team and also our Asian credit research team. So both teams actually work very, very closely together. In fact, they speak with each other multiple times a day, really to analyze and understand the issuers in which we invest in, and for trade idea generation, and of course, credit selection. As you can also see, the credit team is very aligned or well embedded within our global credit platform. So this overall really allows us to benefit from the beauty of having a robust global platform and also on-the-ground in-depth expertise. And that's all I have to share today. Here I summarize the key points that we highlighted in my presentation, hopefully answering the 3 key questions which I set out to answer: why Asian credit now, and why Asian credit via 𝗪𝘆's. So I'll leave this here with you to have a look. Thank you very much for listening to my presentation. I hope you found it helpful. Thank you.